Hey guys, welcome to the Actionable Intelligence Alert interview series. Today I have a pretty special guest, interesting guest. I've been looking for somebody with this individual's expertise for a while to discuss specifics and science and the mechanical methodology of shutting in oil wells, bringing fields back online, this type of thing. It's in the news, obviously, with oil prices crashing, demand crashing because of the shutdown to the economy. So we wanted to bring on somebody that has knowledge on this, and we were able to find somebody. Name's Eric Gagen. He's a petroleum engineer, and he has extensive experience in this field. So I'd like to introduce Eric Gagen, and please feel free to introduce yourself, sir.
Hey, how y'all doing? My name's Eric Gagen. As John mentioned, I'm a petroleum engineer. I've been doing this since the late 90s. My career has been maybe not what I expected, but it's turned out to be very fruitful. The vast majority of it has been spent in the well work and intervention. To put it in non-technical terms, there's basically four groups involved in the oil field. There's reservoir people who figure out what's there. There's production people who turn the valves and manage the facilities. There's drilling people who put the holes in the ground. And then there's workover, which is involved with basically keeping the holes maintained and fixing problems that the production folks have. And that's where I've spent my career, mostly with Schlumberger, as well with some companies, Coiled Tubing Services and Coiled Tubing Partners, through a series of mergers and acquisitions here, there, and the other place. I've worked inland waters, offshore, deep water, land, unconventionals, all in the U.S., basically in the Gulf of Mexico and in the southeastern area, Texas, Louisiana. Little exposure in other areas, but the vast majority of it has been here in this, I guess you'd call it the heartland of the oil field in the United States.
Awesome. So I think we got the right person to talk about what we want to talk about today. And so basically, you know, for our audience here today is mostly laymen when it comes to understanding oil field and oil and gas extraction. But one of the things I've always emphasized in these videos in my newsletter is that petroleum production is an extractive industry. And I think there's a misconception in many cases, or people don't know this or even think about it, that, you know, they're driving down through West Texas or anywhere, Oklahoma, wherever there's oil and gas production, they see those Lufkin pump jacks or whatever, and they think, okay, that's an oil, you know, an oil well, and they just think, okay, that thing puts out, you know, a cornucopia of oil forever, and that's not the case. We've talked about it on the show about, or in the videos about how a well in a field in a region or country, oil producing, goes through a life cycle, if you will. And that, if you could kind of take us through that just as a little small introduction as we get into some of the other things. I don't want to get too far into like King Hubert and all that stuff, but basic life cycle of a field and a well, and the fact that it is an extractive industry and it's not never ending supply.
Yeah. So I guess I mean, the first thing is, you know, you've got a big industry involved in just figuring out where it might be underground. I mean, you know, if you've driven by wells before, there's no obvious reason from the surface to suggest where you might want or not want to put one. And so there's a lot of effort put into figuring out where it's at, using basically kind of like a version of sonar, where they set off explosions and then read the vibrations coming back through the ground to figure out where there's liquids in there. It's incredibly complicated. I'm not the mathematical genius who can explain that to anybody, but it's the first step. And if you think you've got a good spot, then you've got to drill a well to figure out if there's anything there. And at that point, you've got to put a hole in the ground, but these aren't ordinary holes. You know, you're talking about something that might be 5, 10, 15, 20,000 feet deep. And if you ever tried to dig a hole in your backyard or anywhere else, you realize really quickly that it tries to cave in on you. And if you go deep enough, you hit water. So there's a lot of technical challenges that have to be resolved to get to there. If you do hit oil, then you've got the challenge of figuring out how to get it from where it's at down there to surface. If you watch the Beverly Hillbillies, it just shoots out of the ground. That's a big no-no. It makes the 6 o'clock news, and most wells will not do that anyways. Assuming that you've gotten all those steps successful, you can put the well on production, and how much it makes is actually pretty variable. The best wells can make 100 or even 1,000 times better than the worst ones. So when you go past a well, you have no way of knowing if that one is a massive money maker or if it's just kind of getting along, paying the tax bills and keeping the lights on, so to speak. But all of them, even the best ones, do eventually decline. Typically you're looking at, for conventional reservoirs, you're looking at maybe 5 to 10 years of really good production, and then it starts to drop off. For unconventionals, it can be as little as a year or two of good production. From that point, depending on how much might be left in the ground, you can start getting into a lot of engineering tricks to try to get more out. But it gets more and more expensive the more you try to get out of them. And at some point, it's no longer worth it, and you've got to abandon the project. And that means basically making the well safe for future use, right? Filling it up with cement, putting plugs in it so that you can go back to farming the ground, or even putting buildings over the top of it if it's done properly.
And I think that's a good segue into what we really want to get into here, and that is, as the life cycle of the well decreases and its production, there's an economic component that starts coming into the decision making. Obviously, with the operator, I would suggest, I guess, where they have operating costs in addition to their price taker, depending on what the product pricing is. So, for example, I've been reading, or there's been a lot of talk, worldwide demands around 100, or it was around 100 million barrels a day, if you want to include liquids, condensates. But let's say, 100 million barrels a day because of the lockdowns. Depending on who you want to believe, we're down to, down 25, 30 million barrels a day, 10, depending on who you want to believe. So obviously the price has crashed. How does that look for, let's look at like a small operator with, he's got something that's in tertiary recovery, stripper wells or something like that, or even a regular operator. And at what point, how does that process work internally where you say, hey, we're at $25 a barrel and I've got these other costs to service my debt and pipeline costs and maintenance costs and all these other things, where the decision's taken, hey, this isn't economic, I got to shut this in. And then what does that mean, shutting it in, and can it be brought back online? I think that's where a lot of people miss if the price recovers in a year to 50 or 60, can you recover the well and produce again? Or in some cases, you just got to cement these things in and you just can never go back into them again? Okay.
So I'll look at two hypotheticals. One of them is like you said, the real low volume producer on tertiary production. Those guys have margins that are very small in most cases. So the difference between profit and loss for them is often very slim. A lot of their costs are fixed. And what that means is they've got to pay them whether they produce the wells or not. These can include things like maintaining roads to be able to get to and from the wells, paying people to physically go check on them every week or two, painting tanks, making sure you got electricity to all the wells. It doesn't sound like a lot of money, but these are typically small volume, low margin operations. So when their price gets high, when their costs get high, they can quickly get to a point where they're no longer profitable. And the problem with tertiary recovery, so tertiary recovery is when you're using something to force more oil out of the ground. It could be you're pumping water in there to try to flush the oil out, or pumping carbon dioxide in there, or pumping natural gas in there, something to push the oil out of the rock and towards your wells. And the problem is it's a network effect. So you're pumping oil out in a bunch of places, and you're pumping water or gas into a bunch of places. And if you start closing some of them off, then you start losing those network effects. The sum is less than the part that you had before. So let's say you had, I don't know, let's say 25 wells. 20 were producing oil, 5 were injecting water. But if you start shutting some of those wells down, it's going to affect the other wells in the field. And before you know it, you could easily wind up in a situation where, you take, let's say, the worst 4 and say, okay, these ones are no longer good. We'll shut them down. Well, guess what? It's gonna have knock-on effects on the rest of them that you thought were still good, and you can really quickly get in a situation where the whole thing is just not practical any longer. So I guess that's one piece of it. Another piece of it would be, somebody who's got maybe some slightly newer wells, but they've got a lot of debt. And they're in a different situation. Their production might be higher, and their fixed costs are pretty negligible by comparison, but they've got to have cash flow and revenue coming in to pay that bill every month. And they're stuck in a lot tougher situation because they can't just look at their books and say, all right, it doesn't balance, flip the switch, shut it down. They've got to pay the bills. And they are going to be much more strongly inclined to try to keep the wells on production, even at very low profits, or even if they're technically not profitable, if they bring in cash flow sufficient to pay the bills.
So if a decision is taken at some point, like let's use the first example, because I know a guy right now that's shutting in a bunch of stripping wells, and I mean quite a few, and he's I guess, is that done via, they put cement down the well bore or whatever? I mean, I don't know the whole process, but once you do that, like in those smaller producing wells, I mean, it's not going to be worth it to go back later and drill the plug out and bring it back on production. So would it be correct to say that once you do that, not in every case, but I'm sure in the majority of the cases, that's things abandoned forever after that? It's not going to be, put back on production.
That if they actually go to the level of putting cement in it, that is in many cases going to be true. Even if they don't go so far as to put cement in it, so that would be the first steps of abandonment. But if they're just going to suspend production and just stop producing for a little while with no physical barriers to the surface, that's a lot less permanent. But it still carries with it a lot of risks. Most wells that make only a small amount of oil make a lot of water with them. And if you stop producing them, then what tends to happen in a lot of cases is that the water will, when you turn the well back on, the water will be the first thing that comes on. And in a lot of cases, unfortunately, the oil production either never comes back, or comes back at a level that was even lower than it was before. Obviously, that's a huge blow. You've got to pay to dispose of water. This isn't drinking water. You can't dump it in a creek, contrary to popular belief. It's something more like seawater, and you've got to find a way to treat it. And typically, they'll re-inject it deep into the ground. So there's a lot of costs associated with producing water, and of course, you can't sell it. So it's a complete negative.
So we have a situation then where these operators on an individual basis, depending on their situation and the economics of their particular field or their wells, take these decisions. Let's talk about like maybe some of the bigger operators. Obviously, we've seen, I got quite a few friends that have been laid off. I mean, a lot of friends already. They're cutting back on drilling. I looked at the Baker Hughes today. I think we're on oil rigs. The chart looks like it just fell straight down over the last month. I mean, I think we're at the lowest rotary rig count for oil. I mean, it's like around 300 or something. I mean, it's like the lowest it's been in like over a decade. And then I think total rigs, it's like the lowest it's been for several decades. So, I mean, obviously all these cutbacks, all this, trying to save money, they're not going to, no capital investment. But, what about like you see a lot of times you'll see these smaller rigs, or I know this gets into kind of your deal a little bit. I think you see like workover rigs, or you see like coil tubing rigs and things like that that are doing workovers on wells and stuff. Does that stuff start to go away, or that particular maintenance that doesn't happen? How is that cumulative on a field or on wells? What can happen there with like wax builds up, or I mean, I'm just throwing stuff out there. I'm pretending like I know. I'm just asking. Yeah.
So good question. So this particular downturn that we've had has been so rapid and severe that it's affected all those well work processes. There's been a lot of them in the past where it's been less of a severe drop. And what I would call maintenance type operations continue, but they stop putting forth the capital for the big outlays for drilling new wells. This one is severe enough that it's curtailing maintenance operations too. If you think about it like cars, imagine that you've got a fleet of cars that you rent out and they make money for you, and there's no car rental market anymore. Well, at that point, if you had 100 cars and you can only rent out 50 a day, if one of them has a problem, you're not going to put any money into trying to figure out what's wrong with it and repair it. You're just going to set it aside in the parking lot somewhere and go rent out one of the other cars you've got that's still good. And that's the situation a lot of these oil producers are in, is they've got these wells, and if they have a problem with it, there could be a lot of different issues. But if they have an issue, unless it's extraordinarily simple and extraordinarily cheap to repair, they're just going to look at it and go, you know what, we're not going to fool with this one right now. It's done for the time being, and if things get better, then we'll do something with it. And I'd like to circle back a little bit, kind of tie these last 2 points together a little bit, about which wells get shut in. And it's more than just shutting in the bad wells, because there's an axiom or a truism out there. I don't think these are my words, maybe they are, but good wells are always good wells and bad wells are always bad wells. What that means is if you take a really good well and you close it in or do something to it that might be potentially disruptive, the odds are really good that it's going to come back and still be a good well. If you take a well that was marginal to begin with and close it in or do something to it that's potentially disruptive, odds are good that it will disrupt it and that it will cause trouble. So these operators are caught between a rock and a hard place, a lot of them. They'd like to keep production up so that they can get cash flow and pay their bills, but they'd also like to minimize their costs and expenses. And those two things conflict with one another, because the best way to minimize your costs is to close in your bad wells and keep your good wells on. But the best way to preserve your future revenue potential is to maybe close in your best wells and keep the bad ones running.
So when if you say you got one of these, you're out in West Texas and you got these shale wells and stuff, and you have this, I mean, we've seen reported, decline rates on the first year of production. These operators like to put out their initial production rates and stuff, I think a lot of times to impress the market, not necessarily, I think people get the wrong impression that are looking at this stuff. But say you have a well that comes on, it's making, I don't know, I've seen them anywhere, depending on what field, 1,000 barrels per day or something, but then it rapidly declines over the year, anywhere from 50, 60, 70%. When you start, I guess, do some of these wells that have pressure, they flow on their own pressure, or if they have to have downhole pumps, or does that affect if you're shutting them in, bringing them back? Because I've read, you can, we talked about the tertiary recovery, but a newer field or newer set of wells, what kind of damage can you do to these, or what do they have to be cognizant of? I think I read somewhere it's not good to bring the well down to less than like 60 or 70% of its production. You start getting into some danger zones. Did I read that correctly, or am I off base?
It really depends on the well. There are some wells that you can safely take down to a lower level. In most cases, reducing the flow rate is going to be safer than just cutting it off altogether. One real problem that you have is that, you talked about flowing wells versus artificial lift. And there's two schools of thought on that. One of them is, well, we'll let the well flow as long as it can because it's cheap. It does it all by itself. And then we'll install something to lift it and, get remaining production. But there's another school of thought that says, we're going to put artificial lift in there immediately and get maximum production as quickly as possible. That way we'll earn as much revenue as fast as we can, and we'll have our money available to reinvest in more projects. The potential downside of that is those artificial lift equipment do require some sort of maintenance. And one of the popular ones is an electric submersible pump. And that type tends to suffer a lot of damage if the well is left shut in for an extended time period. And they're expensive pumps. They really are. And they're expensive to make, and they're also expensive to get back out of the well. And so if you shut that well in with one of those electric submersible pumps in there, odds are strong that you're going to wind up spending a lot of money when you decide to put it back on production again.
Okay. So I guess one of the things that I'm trying to game out in my mind is, it's hard to tell, we're starting to open up parts of the country, different parts of the world, demand starting to come back. I mean, I don't know about you, but I'm watching the refinery runs, watching Cushing, watching all these different data inputs. But, my thinking was, even before this COVID thing, I mean, the shale industry, or the shale phenomenon, if you want to call it that, really, was carrying a lot of the load for making up for depletion and demand growth around the world. I mean, I've stated this before. I mean, I look at the BP statistical review every year. It looks like demand increases by 1.5 million barrels per day. And it seemed like there was a lot of lack of investment in non-OPEC production capability, finding new reserves. I mean, I've pointed this out before in several other videos. Reserve life indexes, a lot of the majors have went down. And it just seemed like, we had the shale, that up and down in shale when the Saudis a few years ago tried to bust out shale. And it came back after that. And then now we've collapsed it because of this demand situation. Is it something that, okay, if demand were to recover, if we get the best case scenario and everything just comes back in a V-shaped recovery, we can just turn this industry back on again? Because I'm concerned about, if it's prolonged, what happens during these downturns? You've got people that, qualified people, you build up a team. These people just don't go home and sit for some undetermined time. I mean, how do you turn the industry back on? How do you, what really happens? I mean, the equipment can't just sit in the yard in the weather. I mean, all these things go into it. So, I mean, we've had now basically 2 nuclear events, if you want to call them that, in this industry in the last, when was that last downturn? 2014, last 6-7 years. This one's like the worst probably we've seen. I mean, what's your thinking? You've been around for 20 years. When you look at this, how do you see this thing?
If it really is a V-shaped recovery, there'll be consequences, but I think they'll be minimized. The equipment, it's just like the wells, right? If you have a frac fleet and you've got 100 trucks and you've only got demand for 30 of them, you run the 30 best ones. And if something goes wrong with it, you put it off to the side and you pick up one of the other ones. So if there is a quick recovery, then there are going to be some expenses on that end. And getting qualified people is definitely difficult. It's hard, physically demanding work, and it's potentially dangerous. But it's also skilled work, and you can only withstand an influx of a certain number of unskilled individuals before the efficiency of the whole operation starts going down pretty dramatically. You know, I've been there where you've got guys, and you know, they literally don't know what can hurt them, and they, you know, you've got to have somebody babysit them and watch them, and the whole productivity of the operation just drops like a stone. And nobody wants to be in that situation, and that most companies will avoid that by growing at a rate that their personnel allows them to. Equipment is a problem, don't get me wrong, but it's probably less of a problem than personnel. However, I will say in a V-shape, even in a V-shaped recovery, there's a lot of companies that are in severe financial straits right now. I'm sure y'all have covered this in some previous discussions. And, you know, if they're heavily leveraged and they're relying on cash flow to pay the bills, some of those companies aren't going to make it. And if they don't make it, the knowledge that their people have of how to operate these fields is going to be lost. You know, some of it will get retained by people who buy it or what have you, but a lot of it won't be. You know, they may go into bankruptcy thinking they're going to come back out in 2 months and start swinging again. But if you have you know, we've already seen this in a couple of cases where purchases of properties after bankruptcies got delayed or altered because of changing market conditions. So these things may sit there longer than anyone ever thought was likely. And when the new operator finally gets an opportunity to take over, they'll be sitting there with something of a blank slate. They won't really know exactly how to get the most out of what they've purchased.
So it is I mean, depending. I mean, my personal view is this is going to be more like a Nike swoosh than a V. I mean, we're going to have this initial push down, but then, you know, as we come back, I mean, I don't know if we go back to 100 million barrels a day of, you know, recovery. I mean, I guess the wild card for me is how fast does U.S. production? I mean, these guys always seem to be able to get money. Private equity stepped in last time because I think the story was still there, but I think even before this downturn, at least what I was reading and we were hearing, and you can confirm this, I mean, it seemed like a lot of operators were struggling. I mean, I've read some other petroleum engineers I follow on Twitter and other areas. They were like, you know, people talk about tier one assets that people high graded their fields and just to maximize cash flows, and that at some point, like in the Eagle Ford, you know, maybe in the Bakken, they're reaching what's called exhaustion, or they're getting to the, you know, highest level of production they're going to see in those fields. I mean, does that make sense to you? Because I had a discussion with another petroleum guy, and he's like, I don't like this term tier one. I mean, and so, I mean, do you have that's kind of like one of my questions I wanted to ask you.
I'm personally not a big fan of the tier myself as a way of thinking about it, and the reason for that is people have come up with really good and innovative ways to get production out of rock that was previously thought to be lower grade, and in fact, in some cases, it's turned out that the rock that was originally thought to be lower grade was actually somewhat more conducive than they thought it was. One of the big things early on was they were trying to avoid rock that had clay in it. I'm going to get a little bit technical here, but I mean, clay is like, you know, like you might think about like kids playing with, right? It's soft, it's squishy, and the thinking was, well, when you fracture it, it's not going to crack up and break, and you're not going to get good production out of it. Well, it turned out that, you know, rock with a lot of, or at least reasonable amounts of clay in it, actually did a lot better than people originally thought. So there are tiers, but exactly assigning which ones are where is pretty hard to do. But I think you hit the nail on the head when you talked about financial exhaustion. You know, the folks who finance these operations are looking at it and going, hey, show me the money. You know, they were starting to do this late last year, and a little bit early this year, even before we had this whole impact from OPEC and the coronavirus. And the good, disciplined companies who had been trying to live within their means up to this point were saying, that's great, you know, we're ready for this. But some of the companies that were viewing themselves as a growth engine, as a place where they should be growing production on a regular basis, are going to be in trouble because they were borrowing money to get bigger, and now they can't do it. And when the spigot gets shut off on the cash flow coming in, they don't have what it takes to live within their means on their own production, so they're not self-funding.
Yeah, that was kind of another question I wanted to ask you. I mean, that's one of the things I'm looking at from a financial perspective is like these guys in many cases forget about like GAAP earnings, but just free cash flow. And it's like it almost seemed, I mean, I don't know. I remember when oil prices were $90, $100 a barrel, and then even when they were at 50, and everybody's saying, well, you know, EOG or Pioneer, man, they can make money at $30. But it's like, where's the money? Where's the cash flow? Where's the dividends? Where's the return to shareholders? And it just seemed like the metric was grow production, and that was, drill baby drill. I hate to say that, but that just seemed to be what the industry was focused on. I think because private equity and the banks were pushing, capital. So it's like, hey, if you're in the oil business and you drill, if somebody gives you money, you're going to drill. I mean, I mean, maybe I was reading that wrong, but I didn't see. I mean, some of the better operators like EOG, I saw, they were doing pretty good. But you had a lot of companies like Sanchez went bankrupt not too long ago. I mean, they were never going to make money. So I was just like, is this industry really viable, or what can it live in its means? Is there some production level in shale that's, say lower than this, but yet it could still self-fund, it could still produce a decent return for owners?
I think there is, and I think it depends on, like you said, the way the company is structured. EOG is probably the best example out there of a very highly disciplined organization. They got acreage at a reasonable price, nothing crazy. But what they did not go crazy trying to borrow money and get production up as fast as they could. They grew their production much more slowly. So they drilled a batch of wells, waited for them to get on production, sold the oil, and reinvested that money. A lot of other companies and a huge number of investors looked at it as, okay, that say after 2008 and to a certain degree even after 2015, they said, okay, the price of oil is going to be, maybe $80 a barrel minimum for the rest of our lives. So we're going to take all our money, drill as many wells as fast as possible, put them all on production, and then we'll sit back and watch the money roll in forever. Number one, the wells don't operate that way. As you mentioned, and it should be clear to everybody now, they have really good initial production and then they tail off. And number two, the price of oil was not fixed. Never was, probably never will be. You can still make money with that model if you get your cash returned quickly enough. So when the price of oil was, say, $60 a barrel, it still works great because you can drill a well, put it on production, and from the time that you first start spending money to the time you start making money is maybe 6 months, maybe 9 months, depending on how things work out. And you've made all your money back in, a year. And you've got it available to reinvest or do whatever you want. But if you keep reinvesting it in more production, and keep trying to do like an exponential growth curve, then you never get ahead of the game to where you're actually making revenue. And if that was your business model when the price dropped, now there's no way to get back on top of the curve.
Mm-hmm.
And I'm afraid that a lot of those companies are going to wind up going through bankruptcy. That's the bad news. The good news is that the assets still exist, and the assets do have value. They just don't have as much value as the original owners had hoped it would. So somebody, and I don't know exactly who the people are going to be yet, but some folks are going to get some potentially very valuable assets at a very low initial cost.
So that's exactly what we were talking about on our channel here before this bust happened, like late last year even, as the money was drying up for shale. We started seeing some of the operators go bankrupt. and there was a few. I mean, Whiting just went the other day or a couple weeks ago. I mean, that share price was $395 5 or 6 years ago, and it's 40 cents the other day or less now. It's in bankruptcy. But I mean, that's exactly the point. That's one of the things I'm kind of curious about. You know, if you buy an asset, you're exactly right. The asset doesn't dry up and blow away because the management, that current management or that company went bankrupt. It goes to the bondholders or to the bank. They don't necessarily want to operate it, so they want to turn it over to another operator. And if you pay a certain amount, I mean, that's where I'm trying to come at this, is look at it as, if I, like Jerry Jones, I know, Sam Zell, these guys were buying assets in distress. And do you just come in there and say, okay, I've paid enough that I can blow the production down, not just do the requisite maintenance, blow the production down and just get a sufficient IRR, but not necessarily invest in new wells and things like that? Is that, in previous downturns, is that what we've seen? I mean, I'm asking you questions I don't know if you know the answer to. You know, is that how
there has been some of that. I was through a cycle of that in the offshore business. In the Gulf of Mexico offshore, before the deep water really hit big, was dominated by shallow natural gas production. And when I got in this business, it was all being run by the majors, you know, the big companies, the Exxons, the Chevrons, the Shells. They got out of those businesses and sold them off to smaller investors. There was no tremendous crisis, but you know, prices weren't that great, but they sold them off, and the new operators in many cases proceeded to do exactly that. You know, minimal investment, and just get as much production as they can out of them. They didn't necessarily drill a whole lot of new wells, but they did a lot of maintenance and diagnostic work to make sure that the wells they did have were going to be producing as well as they reasonably could. And so they got a fair bit of reserves recovery, which translated into quite a lot of value, and it was a lot of income for them, a lot of profit for them, because they were able to purchase the stuff at a reasonably low price. You know, the big companies at that point in time, they just wanted to get out of the business. You know, they wanted to focus their personnel and their capital on things that they thought would make a bigger impact on their companies. So yeah, I expect there'll be a lot of companies who will be doing that.
That's kind of a good question too. I mean, we've recently seen, you know, as these smaller initial, and I'm sticking on the shale thing again, just because it has had so much impact on the oil markets over the last decade. But we've seen an influx of the majors now, and to your point, I mean, they're looking for something that's going to move the needle. That's exactly right. That's what we see. You know, I mean, that North Sea is just completely now dominated by smaller operators that are, you know, doing things. A lot of the bigger companies pull up, but then we've seen in like West Texas or in the Permian, we've seen Exxon come in there, Oxy. I mean, so are they, you know, the initial geology, a lot of work's been done, the various different levels of shale. I don't know all the different names. I know it's stacks. Did they just wait, and then they've come in, they're going to get the benefit of the previous work, and so that means that is an asset that's really is going to be something, or did they get snookered? Or I mean, I expect when you're dealing with a big company, I mean, it's not just one. It seems like several of the larger integrateds came into the shale, into Permian. I don't think they're all nuts. They must see something that some of the other folks didn't. And I guess they do have the capital discipline. How do you see that influx of those majors out there?
I think some of them bought at the top of the market. They'll still make a lot of production, but they won't necessarily get the profits they were hoping for. Some of them were a lot more careful about how they did their acquisitions. Exxon, while they put a lot of capital into it, and prices are down right now. I mean, they got their acreage quite a while ago, and they got it at a good price. They're probably going to be fine in the long run. Oxy, you know, they built some of their position organically, but they also bought Anadarko at what now looks like a incredible premium. Mm-hmm. You know, they still have a lot of valuable assets, but they're also financially challenged now. They've got you know, they've got those bills due every month to Mr. Buffett and to others, and they've got they've got to come up with that free cash flow. You know, it's not a matter of, well, we'll cut back this month. They can't afford to. You know, if you promise the man a steak and lobster dinner every night, it doesn't matter if you're on a beans and rice budget. You gotta find the money for it somehow.
Exactly.
So
I had a couple questions that some of my subscribers wrote in. I mean, this is going pretty quick, but we've had a lot of recent moves in a lot of we've seen like natural gas stocks have been just decimated. A lot of the operators, I mean, some of the companies are down 90-95%, but they've since jumped in the last month or so. And I think a lot of the story was, or seemed to be, we have seen gas production decline. And what I wanted to ask you, the question was, is as production in the shales goes down, there's a component of that production known as associated gas. How relevant is associated gas? Is that really the whole story, or is it just that they're kind of ran out of money too, and they've been having to pare back, and at some point low prices cure low prices because you're in an extractive industry? I'm not sure. I read different articles, but I'm not sure how much the associated gas. I know it didn't completely overwhelm things, but it was, you know, you heard the stories where they couldn't even give it away. They didn't have pipeline, the flaring and all that stuff, but they were piping it out, and it was just like ridiculous prices. I mean, is that?
Yeah, negative prices in many cases, which at the time was unprecedented. That's the waste of associated gas is probably going to be greatly reduced. I mean, if you've got people shutting wells in, or if you're not drilling lots of new wells, the associated gas production is going to go down. But I would caution it as being a savior for two reasons. Number one, the price of gas is still not very high. You know, it's selling compared to what oil was doing. I mean, obviously it hasn't dropped nearly as dramatically. So it's better in comparison, but it's not good overall. And the second part is, you know, as the associated gas that is wasted drops off, more of it's going to get sold to market, or a larger fraction of it is going to get sold to market. And there's one other issue, which is that as oil wells deplete, the amount of oil goes down, and typically the amount of water goes up, but the amount of gas also goes up. So you're not going to get an absolute increase in gas in most cases, but as the oil goes down, the gas doesn't go down as fast. You know, and we've got declines in the electrical markets as well. Not as severe as everywhere else, but natural gas is a electrical generating fuel. You know, it sells abroad. The U.S. is a net exporter, so the marginal volumes of natural gas have to get exported, and there's a lot of competition out there for from other natural gas exporters. Qatar, Australia, you know, a lot of new projects that have come online, and those projects might be expensive. They might run at a loss, but if they don't sell anything, they run at an even bigger loss.
Exactly. I want to ask you a technical question. I don't know how much experience you have with this, but one of the things that was working fairly well for me, because I do mostly, when I'm dealing with any of these oil and gas producers, I'm usually looking at free cash flow as my metric in a lot of cases, because that's going to really tell the story. Earnings can be jacked around with, I get that. I mean, free cash flow after, you know, investments, maintenance, all this stuff. So one of the things I was seeing was in Canada, there was a couple companies I actually did own a little bit of, like Meg Energy, for example. They have SAGD operations in the oil sands, you know, steam assisted gravity drain. And I was wanting to ask you a technical question on that, because some of the operators, they were talking about having to, you know, to shut that down. I mean, obviously you're injecting steam and heat into the ground constantly to, you know, make the bitumen viscous so that it can flow to the well bore, to the piping that extracts the oil or bitumen. If you shut down a SAGD operation, I mean, what's the potential to impair that? Or is it just a matter of you just have to heat it back up again? Or is there a possibility you can damage that reservoir? Or, you know, do you have to keep some heat on it once you've started that process?
That is a great question. I know enough to be dangerous. I've done some work with thermal stuff in California, and to say that you just have to apply a little more heat is actually a big undertaking, because the amount of heat that is required to get these things up to producing levels is actually really high. It takes a lot of fuel in the form of some other either natural gas or crude oil or coal or geothermal, a lot of heat from some other source to get these things warmed up. And, you know, you're basically, you try to keep the heat contained, but I mean, it's the whole earth, right? I mean, all the rocks are connected to each other. Mm-hmm. So what you're really hoping to do is put heat into your little area that you're trying to get oil out of faster than it can leak off to the rest of the world around you. And that, if you stop putting heat in, it dissipates. You know, exactly how quickly depends on, you know, exactly where you're at and how far along you are with the process, but it's not just going to be, you know, turn the burner back on and it heats back up. It's a slow process. So if you turn it off, it's going to be a while before something gets on. But that's actually the good news. The bad news is that the oil that they're producing out of those heavy tar sands, and they call them tar for a reason. The common technical name for it is asphaltenic or asphaltene type oil. And if that sounds like asphalt, it's because it is. So when they're producing it and it's heated up, it tends to flow kind of like gravy. But when you cool it back down, depending on exactly what the oil was like to begin with, there is a chance that it can basically crystallize into solid asphalt. Mm. And if that happens, then you're done.
So depending on the reservoir, based on the engineering they've done before, they may have to say to themselves, we got to keep heat on this regardless of the price. Meg, for example, they have a lot of their production hedged for this year, but you know, the hedges run out at some point. If the price doesn't recover, then you're back in trouble. But there is a potential then that you could damage the reservoir. You could damage the reservoir permanently, and yes, if you okay, that was the
yes question. In most cases, it'll probably only be damaged near the wells, so you could, in theory, get things going again by drilling new wells. But at this point, you're basically starting over from scratch. You know, you do have some things going for you. You've got your surface facilities, you have your title to the mineral rights, but you're going to be looking at a huge investment to get restarted again, if that's what happens. And unfortunately, a lot of them do. So does anybody here know how to make gravy? Yeah. I'm asking because so you take flour and you take water, flour, and oil, you heat them up, and then when it cools down, it's thicker than it was to begin with. Yep. That's what an asphaltenic oil is like. It may be kind of fluid to begin with, but when you heat it up, it's more liquid. But when you let it cool back down, the asphaltene particles then kind of conglomerate, and it's thicker than it was to begin with.
Excellent.
So yeah, that's the risk they run.
So I want to kind of shift gears because we're getting to near the end, but I wanted to ask you a question, and you don't have to answer this. You might, I mean, you know, I don't want you to professional. Several years ago, before the shale boom, you know, we live on a finite ball here, and from an economics perspective, you look at just, I mean, I love the oil and gas industry. I'm in the energy business myself, utility side, generation, coal generation, nuclear, now renewables. Don't get me started on that. But anyways, that's what I do. And I've had a fascination with the oil and gas industry. I mean, my own view, and I've said this many times, is that oil and gas, natural gas, has basically enabled our civilization to reach, it basically allows civilization. It's the lubricant for it. It permeates everything. I mean, I think I saw a picture in Forbes one time where they just had arrows pointing to like 70 things in this person's living room that were all of some type of petroleum extractive. I mean, people have no clue what that is. And, you know, we're on this finite ball as the earth. And from an economics perspective, if you just talk to an economist, they'll say, well, you'll never technically run out of oil. You'll never, because the price at some point would rise if that was the case. But, I think people they'll look at reserve life indexes of the majors, and they'll say, like Exxon will say, well, we have 10 years of reserves, but there really are a lot more reserves. I mean, it's basically, you're not going to go out there and drill and spend a lot of money trying to find oil and natural gas if, the price isn't right, or it can't meet the investment hurdles. I mean, when you're looking at this as a petroleum engineer and you're going through your schooling, you're saying, okay, this is a ball. I mean, you look at, a place like Saudi Arabia. I guess where I'm getting to the question is, I read Matt Simmons's book, 10 or 15 years ago, Twilight in the Desert, like the Saudis. I mean, they've had 250 billion barrels of oil reserves for the last 20 years. It never changes. So I don't think that that's true. They lie, obviously. But I mean, what are petroleum engineers taught about, hey, this is a finite ball. People look at it like it's a milkshake, a glass, to use that in that movie, I drink your milkshake. But I mean, what are you guys taught about, ultimate recovery, the total resource on the earth? I mean, how does that come into your thinking?
At the time I was in school, there was a lot of when you get to it's being taught, people were concerned that we would be running out. Since then, two or three things have changed dramatically. One of them is the shale oil, which there's an enormous amount of it out there, and the wells that we're drilling into it right now are getting out a very small portion of it, very small. Typically somewhere on the range of 5% of what's there to begin with. There's a lot of room to make that a lot better if the price were right or if the technologies were proven. Second one is things like those tar sands in Canada. The Canadians are not lying about their resource. Anybody can go up there and look at it for themselves. I mean, some of it's literally sitting on the ground. Same thing in Venezuela. Nobody can get to Venezuela because it's the political situation, but the stuff is there. I agree, OPEC does not tell the truth about their reserves. But even if you only look at what is readily available for analysis in other places, personally, I come to the conclusion that we will turn the Earth into Venus through warming before we run out of oil. Which means we won't do that. Well, yeah. We're an innovative lot of people. There's a lot of great ideas out there besides oil and gas. They've been vital to our economy and will continue to be for quite some time to come. But I don't think we're going to run out. It looks like we're running towards the end of the age of coal, and there's still a lot of coal out there. If you live in Wyoming or travel up there, drive down Interstate 80, you'll see coal seams where they make cuts in the hills to build the road. And nobody's mining it because it's not worth it.
No, you're exactly right. It's one of the things that I just have a fascination with is how technology, and you say, original oil in place and then their expected recoveries, and I've seen single digits, and then the people just keep coming up with more and more technology, whether it's chemicals, CO2. There was a big company that I used to follow down in East Texas where I was running around Pearland. They had a field, I can't remember the name of the company, but they used to take CO2, put it into the field. All these innovations that even if you can get 2 or 3 more percent out of these huge fields, it's this tremendous amount of energy. So I think I tend to agree with you. There are limits to it, obviously, in the geology and things, but we barely even scratch the surface in many cases, it seems.
Yeah, I would say most of the limits at this point are economic. What is it worth it?
Exactly.
Technically, from the point of view of effort in versus effort out, you could probably run the whole world on algae or corn. But boy, would it be a lot of work. It's so much easier to do it in other ways. And that's, let's face it, as fascinating as it is, we don't live to eat, or well, some people live to eat, but we don't live to eat, or we don't live to make energy. We do these things so that we can do other stuff, and we want to do it without putting an enormous amount of effort into it if we have the choice.
Well, that's what I kind of tell people when I'm having these discussions with them about environment and things like that. It's like, we're not extracting these things and using them because there's a bunch of fat guys sitting in New York smoking cigars, laughing about polluting or whatever their people think they're doing. It's because they're cheap, ubiquitous, and easy to use, store, transport. That's why. And to your point, with the innovation, we'll eventually move away from these things. When I look at the BP statistical review, they go out 30, 40, 50 years, and those things are in decline: coal, natural gas, and oil, but they're very small declines over time. So the expectation is they're going to be here for a long time. So,
Yeah.
So we come up on an hour, Eric. I don't want to take too much more of your time. We answered a lot of questions. We covered a lot of territory. With this current, I'm not asking you to be a forecaster or ask you to, but you obviously you have an opinion, and you've been through several of these things before. I think that low prices cure low prices. I always go back to that sticker that I know you've seen on the back of pickups. Please, Lord, give me one more oil boom. I promise I won't mess it up. So this is an industry that's cyclical, very cyclical. It seems more cyclical now, but when I go back and actually look at it, it's historically been like this. But what do you see? I mean, low prices do cure low prices. Production does go down over time, and if you don't make the requisite investments, at some point the price recovers and you start the cycle again. Is that your sense?
Yeah, I think so. I'm personally counting on it. My expertise is basically diagnostics and repair of well problems. And literally today I got word from my lawyer that my company EPG Solutions, co.com, has been incorporated in the state of Texas, to hopefully try and help some folks with this, because I really truly believe that there's a lot of value in these assets, and whether it's the current owners or whether it's future owners through some sort of sales or bankruptcies, they're going to get these assets and going to be sitting here going, how do I get what I was promised out of these things? The stuff's in the ground and I've already got wells in the ground, but how do I get the stuff out at a reasonable price so that I can recoup my investment and get the income that I was expecting? And I think that's going to happen. I have no doubt about it. Probably won't happen at $22 a barrel or whatever it is today. But
yeah, I think before we came out, they had rally all this week, so we're pushing $30 a barrel on WTI. So we'll see what happens. But hey, man, I know that you're getting caught up in the downturn. It's nothing new for you. We wish you the best of luck, and we thank you for coming on here and spending an hour with us and educating us. Is there anything else that we might have missed, or something that you would like to add that I didn't cover, or something that you think is important around this discussion?
We covered a lot of points already. There's a few technical issues that I think will be interesting, but we don't know how they're going to play out. Looking for more oil is probably not going to come back anytime soon. Drilling new wells is going to come back slowly, but repairing and diagnosing existing wells and maximizing production of existing wells, that's going to come back very quickly. Right now, people aren't even doing those things. They're either running around with their pants on fire or they're looking for matches. But that's going to settle down. We're going to beat this virus mess one way or another. Don't know exactly how yet. That's not my expertise. And we're going to dust ourselves off and figure out what we have and figure out how to make the most of it.
Yes, sir. On that note, I mean, we always come back. That's what we do here in America. So I agree with you. All right, man, I appreciate it. And like I said, we'll if anybody wants to get a hold of you, can they if they have any questions or anything, or if they hear this and have some interest in any of your services, they just hit you up on LinkedIn. That's where I kind of found you. Is that the best place to get in contact with you?
Yeah, I'm going to be setting up some other avenues, but that's for sure right now. There should be more to come, but that'll be posted on LinkedIn as well.
All right, I'll put a link to your LinkedIn page, and like I said, I definitely appreciate you spending this hour with us, and you answered quite a few questions, and we're very generous with your time. So thanks a lot, sir.
All right, you're welcome.
All right, have a good one.
All right, you too.